Hi, good afternoon. Um, I'll be trying to do some series of videos with reference to accounting, and I'm going to be looking at the topic of changes in partnerships, and I am going to look at a partnership change by way of an example question, and this question was taken from the A-Level Accounting book by Harold Randall, and that is found in chapter 7 and it's exercise 2. This question has been slightly modified so as to give some explanation. Now the question here states that Crook and Shank were in partnership in a firm of general dealers, sharing profits and losses in the ratio of 3 to 2. They made up their accounts annually to 31st of March. On 1st of October 19-1, they admitted Spindle as a partner. Spindle paid $20,000 into the firm's bank account on that date as capital. The new partnership agreement allowed interest on cash introduced as capital at 10% per annum. Spindle would receive a salary of $4,000 per annum, and the balance of profits or losses would be divided as follows: Crook 2/5, Shank 2/5, and Spindle 1/5. Information extracted from the books of the firm for the year of 31st March 19-2 was as follows. So we have sales of $190,000, cost of sales of $100,000, and remember that cost of sales is also called cost of goods sold. And how we calculate our cost of sale or cost of goods sold, that is usually calculated by taking our opening inventory. To that we would add our purchases and subtract our closing inventory. That is the basic way of calculating our cost of goods sold or cost of sales. So we didn't have to calculate it, it was given to us as $100,000. Then we have some expenses like wages and salaries of $21,000, rent and rates $8,500, light and heating $3,200, general expenses $2,400. We also had a loan made to the firm by Crook on the 1st of October 19-1 at 12% per annum of $10,000. So the loan from Crook was $10,000 to the firm. Motor vehicles at the beginning of April was $20,000. They were valued at $20,000. And then you have a motor car bought into the firm at a valuation, and this car was bought in by Spindle and it valued $8,000. The allowance for debts for the year at 1st of April 19-1 was $500. And the accounts receivable at the end of September 19-1 was $12,000. And we had additional accounts receivable, and this accounts receivable was at the 31st of March 19-2, and this accounts receivable was $14,000. Then we had capital at the beginning of the capital accounts at the beginning of April 19-1 for Crook and Shank respectively was $40,000 and $20,000 respectively. And then we were also given some additional information, and the first piece of additional information we were given, it said rent and rates be paid at 31st of March was $2,500. Heat and lighting owing at the end of March 19-2 was $800. General expenses incurred to the 30th of September was $1,000, and motor vehicles are to be depreciated at a rate of 20% on costs or valuation. So whether you were given the cost of the motor vehicle, which is the historical cost of the motor vehicle, or whether they value the motor vehicle and give you the value of the motor vehicle at the point in time, the depreciation is to be calculated on the motor vehicle at 20% per annum. They also said that the allowance for doubtful debts to be maintained at the rate of 4% of accounts receivable. So our allowance will be calculated based on 4% per annum on the accounts receivable. So then they said, owing to the seasonal nature of the business, a third of the sales occur in the period September 30th, 19-1 of the financial year. And finally, they're telling us that all sales produce a uniform rate of gross profit. And what this means is that just how the business earns sales during the year, that means that the profits were generated based on the way the business earned their sales revenue. So which means that a third of the profit was earned in the period that ended up the 30th of September 19-1, and 2/3 would then will go from the 1st of October to the end of March 19-2. So what we are required to do, we are required to prepare an income statement and appropriation account of the partnership for the year ended the 31st of March 19-2. Now, we have spoken before that a partnership can change for several. A partnership change can occur if the partners decide to change their profit sharing ratio. That's a change in the agreement. So you can have a change in the agreement. You can have that a partner retire from the partnership. And you can also have that a partner admit a new partner into the partnership. So therefore, you will have changes in the agreement. And as long as there are changes within the partnerships, as mentioned a while ago, then the old partnership will cease and a new partnership will start, and you will have a new agreement. So one of the first things that we have to look at when we are looking at this partnership change is that we have to look at when the change occurs. So we have that and one of the things that we need to identify as well is the financial year of the business. And the financial year of the business does not necessarily have to follow the calendar year, which is January to December, but it can start any time of the year. So the financial year of this partnership started from the 1st of April and ends the 31st of March. So it starts the 1st of April 19-1 and it will end the 31st of March 19-2. So that's the financial year for this business. So now that we have established the financial year, the next thing we need to look at is when the change in the partnership occurred. And this question stated, if we go back up, we will look and see that the question stated that on October 1st, the partnership decided to admit Spindle as a partner into the business. So we had a change in the partnership agreement for October 1st, 19-1. So let's set up for our income statement and statement of appropriation. So we have Crook, Shank, and Spindle. Income statement and statement of appropriation. So this is we're beginning to set up for our income statement. So we have that the old agreement was from the 1st of April to the 30th of September, right? So that old agreement was from the 1st of April to the 30th of September. And that is for 6 months. We have the new agreement starts October to 31st of March. So this is October 19-1 to 31st of March 19-2. So let's start by calculating our gross profit. And we know from earlier in accounting, introduction to accounting, that we will calculate our gross profit by taking our sales and subtracting our cost of sales or cost of goods sold. So our sales, we were given sales of, and we look here, our sales is $190,000 and our cost of sales $100,000. So sales $190,000, our cost of sales $100,000. So therefore our gross profit would be equals to our sales minus our cost of goods sold. So our gross profit is $90,000. So we have gross profit of $90,000. So now that we have established that our gross profit is $90,000, we have to look at prorating this gross profit according to the change. And based on the information that we were given in the question, it stated that owing to the seasonal nature of the business, that a third of our sales were earned between the period of April to September 30th, 19-1. So if our sales were earned, a third of the sales were earned under the old agreement that they would have had between just Crook and Shank, then it would stand to reason that a third of this gross profit here, as they're stating that all sales produce a uniform rate of gross profit, it stands to reason that a third of our gross profit here is for the period which is the period 1st of September to the 30th. So that would be 90,000. So that is 90,000 times a third, is 30,000. And then we have this period here, which will be 90,000 times 2/3, which is 60,000. So now that we have established our profit, it will be less our expenses. And our first expense, wages and salaries. Sorry, our salaries and wages. And it told us that our salary and wages for the period was $21,000. And salary and wages, $21,000. And instead of our additional information, they didn't tell us anything additional with reference to the salary and wages. So our expenses, when we have a partnership change, our expenses are prorated according to the time basis or according to what is instructed within the question. So saying that this period is 6 months and the next period is 6 months and the total for the year was $21,000 in salary and wages, we are going to take our salary and wages and divide it by 2, so it will be half, which is $10.50 for the first period and $10.50 for the second period, which would give us our $21,000 for the year. Our next expense, rent and rates. And we were told that our rent and rates were $8,500. And they told us that rent and rates prepaid at the end of the period was $2,500. So if our rent and rate was prepaid, we will recognize that if we have a prepayment that means we're paying forward an expense, we're paying it for another period, not the current accounting period. So therefore our rent, that $2,500 that is paid for a future accounting period, has to be deducted from the $8,500. So when we subtract our $2,500 from our $8,500, we were left with $6,000 for the payment of rent and rates for this accounting period. So now we have to take, so put that here, 85 through the word K minus the prepayment, which gives us $6,000. Right? So therefore, the $6,000 then would have to be split between the old agreement and the new agreement. So we have 6,000 divided by 2, which is $3,000. So we have our total rent and rates paid for the year of $6,000 that we are supposed that we incurred for the period. Our next expense we're looking at is lighting and heating. So lighting and heating, and with lighting and heating, the expense that was paid out is $3,200, but it's telling us that heating and lighting owed for the period was $8,800 at the end of the period. So this means that we use up this $800 to help us generate our revenue. So we have to match our expenses with the earning of our revenue in the period in which it was incurred. So therefore, we only paid $3,200 for light and heating, but we still owe additional $800. So this $800 must be added to the $32 to give us a fair picture of the light and heating that was incurred during the period. So that's $3,200 plus the $800, which gives us $4,000 as our light and heating for the period. So total light and heating incurred $4,000, and that again is split evenly between the two periods. Our next expense will be our general expenses. The question stated that general expenses were $2,400, but they're telling us in additional information in note 3 that general expenses incurred to the 30th of September was $1,000. So they're saying under the agreement with Just Crook and Shank, they incurred $1,000 in general expenses. So that has to be accounted for within that period, which means that the remainder was incurred in the period when they admitted spindle. So then the extra $1,400 would then go to the period for Crook, Shank, and spindle. So we have our general expenses, and they specifically said that $1,000 was incurred during this period, and then the other 14 will be incurred for the next period. After our general expenses, we have our loan. There's a loan made to the firm by Crook, and this loan was $10,000. So saying that this loan is $10,000. So we had a loan of $10,000, but this loan was made to the firm by Crook on the 1st of October. That is very important to know, that when the loan was made to the firm, to the partnership, this loan was only made on the 1st of October, which means that this loan was made in the second half of the year, and also it was made at the time that the partnership admitted spindle into the partnership. So we must always calculate our interest on the loan. So they have given us a per annum rate for our interest of 12%. However, we state that if no interest rate is given for a loan, the interest rate will be calculated according to the Partnership Act, which will be a rate of 5% per annum. So if you have a question and you were not given an interest rate, then you go according to the Partnership Act and you calculate the interest rate on the loan by the partner at 5% per annum. And this is the loan by the partner, not a loan from someone outside of the partnership. So we have loan interest. And as we said, this loan was not made during this period here. We didn't have, between April and 30th of September, there wasn't a loan. Crook didn't give a loan to the partnership. He bought in the loan here. At the beginning of October, he gave a loan to the partnership. So that is $10,000 multiplied by 12%, which is 0.12. And then that is divided by 2, which is $600. Why divided by 2? Because that this partnership change occur, you have it split in 6 months period.